So in this video lecture, what we're going to do is go through the intro to valuation. And in this class, we're going to go through the residual income method and the discounted cash flow method, and then we'll also go through the multiples methods as well. So in this lecture, we're going to go through an intro to residual income and DCF. So if you are finance heavy as far as your major focus, then some of this will likely be a bit of a repetition from what you've seen in other classes, but the final case for this class will be going through a DCF valuation analysis. So I just want to hit on some of the main points that you'll be needing for finishing up that case, which is the final component of this class. So on Thursday, which will be the final lecture for this course, we will go through the residual income method and applying it to the Coca-Cola case. We will also finish going through the DCF and multiples method by going through it with the Ferrari case. And on Thursday as well, we're going to go through the main points of multiples valuation and compare that to the two methods that we're doing today. So when we're looking at valuation in general, usually what you're doing is making a set of assumptions and looking at how you're going to project those onto the financials to see how your financials are going to look if certain future conditions prevail. However, as we'll see in the Ferrari example and also in the final case that you guys will be doing, your financials are only going to be good as the assumptions that you put into them. So a very important part of analysis is going to be making sure that you do your sensitivity analysis to make sure that your valuation is as conservative as possible. So when we're looking at preparing a set of pro forma financial statements, we're going to start with making various assumptions as far as how we see the level of business continuing in the future. And we're going to project out our operating revenues first, and then look at projecting out our operating expenses given that set of revenues or growth that we expect. Then we're going to project our assets that are going to be required to support that revenue growth, determine if and then how much financing we're going to need in order to support that growth with the assets that we'll need to have in place. And then we're going to project out the cost of financing. Specifically with the DCF method, then we'll need to take this a step further and project out cash flows based on our assumptions about the timing of our revenues and expenses, and project out the cash flows so we can discount those back to get a present value for our business, or if we're looking at doing a certain opportunity, to see what the value of that is, to see how much we're going to pay for that currently. So when we're looking at the various steps of stock valuation, so for this class we're going to consider valuation in the context of valuing stock, so as if we're going to purchase another company. There are four main steps that we're going to do, and this is going to take us now through all the steps that we have done in class in order to analyze a company's financials and figure out what information we can determine based on what's going on in the financials. So step one, we're going to look at understanding the business environment and accounting information. So as we've seen throughout the themes in this class, how a company is operating is going to be dependent based on how the company, what industry the company operates in, and the company in general, just how long they've been around. And that's going to be impacting what we see as far as the financial ratios on the financial statements. And that's going to impact then what we use as far as the assumptions and inputs in our valuation. Then we're going to look at, do we need to adjust or assess differently any of the financial and accounting information? So we'll want to see what business strategies or what decisions is the company making currently, and is there anything that we need to do to the financial statements in order to change that based on what we're going to do when we acquire that company. So a big example is if you are acquiring another company and you're looking at how you want to value them to see what price you want to pay for that company, then you'll want to see if you're going to do anything differently to that company, such as drop certain divisions, because that would impact then what you need to do to massage out that information in the company's financials in order to, for example, project a different level or a different set of revenue growth assumptions. Or if we're going to sell off certain assets, so sell off certain divisions, we'll want to remove those from the financials when we're making certain assumptions and when we're doing our valuation of a company. Step 3 is the big one then, that's forecasting the financial information. So where do we see the firm going in the future? If we're going to acquire, what are those assumptions that we're making for revenue growth, expenses growth, etc.? And then step 4 is what is the firm worth, and just using that information for valuation. So something that we'll see is that when you are, for example, valuing another company for acquisition, you'll want to consider doing multiple types of valuations and comparing for example, the per share stock price that you get from each valuation to see which one do you want to put the most weight on in order to see what do you really want to value that company with or as in order to figure out how much you're going to pay for that company. So like I said, step one is trying to understand the business environment and the accounting information. So really analyzing the quality of that accounting. So we've looked at certain examples in this class to see how companies are operating and what things impact the company's financial statements. And we know that certain companies, for example, are going to have a certain, for example, the Amazon example, when we saw that Amazon has very low book earnings or GAAP earnings, but a high level of cash flow coming through. We want to analyze what really is the health of that cash flow. So we've looked at Amazon in the context of capital leases. We want to see how is that impacting the company's financial statements? How is that impacting their cash flows? Do their competitors do that in the industry? So when we're doing, for example, a multiples analysis, when we're valuing companies based on multiples, we'll want to make sure that we are able to compare apples to apples. Other things are evaluating future growth opportunities is a big one because we'll want to make sure that when we're looking at a company's revenue growth, what's going to hinder that going forward. So for example, the UST case, when we looked at UST had very good growth in the past, but they might not be able to sustain that growth going forward. So for example, maybe a 5% revenue growth annually isn't something that they'll be able to achieve. Other things are just when we're understanding the business environment is understanding the industry that that company operates in. So UST had significant regulatory challenges and potential fines, and they did experience a very large fine after the case that impacted, for example, their ability to pay dividends going forward. And that's things that we'll just want to continue to consider when we're doing a company's valuation to see which outside things can affect the company as far as maybe doing a SWOT analysis or pros, cons, or whatnot of seeing whether the company continue to experience a historic growth, the historic expense levels, and what's the likelihood of that continuing in the future. Step 2 is adjusting and assessing financial and accounting information based on the inputs that we saw in step 1. So for example, a crucial step in understanding a company's security or stock valuation is making sure that the inputs that we put into our model are something that the company is likely to experience going forward, and to make sure that the company, when we're comparing the company to other companies and seeing, for example, how much we want to pay for this company, we want to make sure that our company that we're analyzing is having, for example, accounting methods or accounting rules that are impacting them the same that we would see for other competitors in that industry. So going back to the Amazon or the UST examples and just making sure that we're really doing a good job of estimating that impact going forward. Step 3 is forecasting financial information. So this is the bulk of what we'll be going through today. But we're trying to figure out what is the rate of growth in expenses going forward? What is the amount of assets that we have on our balance sheet? So trying to figure out how to forecast our balance sheet assumptions. Then the other main component of this is estimating the cost of capital, or the amount or charge that we're taking. For example, is what we'll see in the residual income method. We'll have a charge for our equity cost of capital, and that's significantly going to affect what we value a company at. And then in the DCF method, we're using the cost of capital to discount our cash flows, our future cash flows, back to a present value today, which would be the amount or the value that we would have for the acquisition price for a company today. Step 4 then is going to be using the information for valuation. So 2 components to this. 1, making sure that we're using the correct valuation method, whether it be residual income or DCF, or making sure that we are doing the correct sensitivity analysis and, for example, doing a best case and a worst case situation based on our assumptions to see what is the range for a valuation of a company, to see what we really want to pay for a company today when we're acquiring a company. So this is going to be the most important part of our analysis, because this is really going to be something that we want to spend enough time on to make sure that we really are getting that correct value to acquire a company at today. So before we jump into how to value equity instruments, when we're looking at valuing an equity instrument, it's actually going to be pretty similar to the valuation of a debt instrument. and that's going to be looking at two components to see what we have for the value of a debt instrument, and we'll see how we look at valuing an equity instrument because they're going to be quite similar. So when we're valuing a debt instrument, we're going to look at a few components. We're going to be looking at the coupon rate, which is going to establish the interest rate that we're going to have for a set of payments. We'll have the face value, which is going to be that lump sum payment to be made, for example, at the bond or the debt instrument's maturity. And then we'll have the market rate, which is going to be the interest rate that an investor could earn by investing in other bonds with similar risks. So we're going to be comparing that to our coupon rate to see how, for example, what an investor is willing to pay to invest in our bond up front. So you guys have seen this in other classes, but if we're looking at valuing a debt instrument example, it's just going to be looking at how much a company is willing to, or how much an investor is willing to pay for a bond in a company today, and what that bond is going to be worth in the future. So typically that face value is going to be $1,000. On this example, we have an interest rate or coupon rate of 9% on a 3-year bond, a face value of $1,000, and a market rate of 10%. So here the coupon rate is less than the market rate, so that would mean that we're looking at a discount bond. So we would expect the investor to pay less upfront for this bond because they're going to pay less than $1,000 because they're going to receive $1,000 in the future. So here the investor would earn $90 on interest, so 9% coupon rate for the next 3 years on that 3-year bond. They're going to receive $1,000 in the future. And then if it's going to be a discount bond, their present value using a 10% market rate for this bond would be less than $1,000. And here the present value would be $975. So the investor is going to be willing to pay $975 today in exchange for receiving three annual payments of $90 and one payment of $1,000 at the end of the 3 years. So if we compare this to an equity example, using the same type of mechanics in terms of the rate that we're going to get paid for this instrument and what we expect to receive at the end of the life of the instrument. So let's say that we have a stock that pays a $90 dividend. So just like our $90 coupon payment in the debt example, saying a stock pays a $90 dividend at the end of each year for 2 years. And then at the end of the 3rd year, we're going to receive a $90 dividend again. But then we're also going to expect to sell the stock for $1,000. So just like the face value in the debt example of $1,000. So if we look at the returns in this example, we're going to get $90 each year for the next 3 years. And then we're also going to sell the stock for $1,000 at the end of the at the end of the 3 years. So here we would expect or only want to pay $975. That would be the present value of this investment today. So we pay $975 for this stock in exchange for receiving $90 a year for the next 3 years and selling the stock for $1,000 at the end of the next 3 years. So this is just comparing how an equity instrument value is looking just like the debt instrument value. We're just going to use then different assumptions and having to come up with those assumptions and forecast ourselves to value the stock or the equity instrument. So when looking at the overview of the forecasting process, it's very straightforward in terms of what we want to forecast, but just understand these conventions when we're starting to do the forecast process. When we're looking at reformulating the financial statements, it's based on assumptions that we expect to persist in the future. The key word there being persist. Obviously, certain things can occur in the next however many years that we're doing our forecast for that we have no expectation could happen based on the set of knowledge that we have today. So that's going to be a key underlying convention that we need to keep in mind when we're making the assumptions for our valuation. The other two things are garbage in, garbage out. The quality of our decision is based only on the quality of information that we have today. So that's why we really need to make sure that we're having a conservative range of values when we make our valuation. And then the other thing is just understanding the blend between optimism and conservatism. So usually when a company is making a valuation, for example, to potentially acquire another company, there's incentive or desire there to acquire the other company. So they want to acquire that company. We want to make sure that we're not impacting the valuation with our desire or optimism as far as how well we think we can acquire or integrate that company with our own and how much we want that integration to work. We need to make sure that we're being very conservative and black and white in terms of whether this might work out based on making sure that our assumptions are conservative enough to produce us with an accurate value today to make sure that we don't overpay for a company. Okay, so when we start looking at the forecasting steps, we're looking at, like I said, forecasting our revenue. So that's going to be based on the expected growth and the current business strategy of the company. We're going to look at forecasting our operating and non-operating expenses. For this class and for the final exam, we're primarily just going to focus on our operating expenses. Then we're going to look at moving to the balance sheet side of our financials. So we'll be looking at forecasting our operating assets, liabilities, and equity. And for now, we're just going to assume that there's a relation between the revenue accounts and each of our specific balance sheet accounts. And then once we do our assumptions in the real world, so when we forecast out our income statements, so our income and expense drivers, and then we forecast out our balance sheet, for example, to see what level of assets do we need to have in order to keep up this growth going forward. Typically, you won't see the balance sheet, so the assets, our liabilities, and our equity. Typically, you won't see that balance 100% based on our assumptions and what our drivers are for that growth and our expenses and our assets. So when we do that, sometimes you'll need to make minor plugs in order to get the balance sheet to balance. And in the real world practice, we typically just plug our assets for short-term investments or our liabilities for short-term debt in order to balance the balance sheet. If there's large distortions in your balance sheet at the end of the day, after you finish up all of your assumptions and calculations, you'll need to go back into your balance sheet and your income statement to see where any of those errors could be, to see what we need to do in order to make sure that our forecasted financials do balance out accurately at the end of the day. So in the next few slides, we're going to dive into each of these 4 steps, or these 3 steps, the revenues, expenses, and our balance sheet steps, further to see what's really driving each of these accounts and how we can manipulate these accounts based on the assumptions that we're making. So first off, when we look at forecasting revenues, it's very generic, pretty easy. We're just going to forecast our revenues based on what we expect our revenue growth rate to be. The main thing is going to be, first of all, do we want to look at our historic revenue growth rate, or do we want to look at what our expectations are based on our future revenue growth rate? So for example, if we're looking at a company, like we talked about the BlackBerry example in our class, how BlackBerry it had very great growth back in the 90s and early to mid 2000s until the late 2000s, until Apple came along with the iPhone in the late 2000s. So this would be an example of a company that would ideally have not relied on historic revenue growth rates in order to figure out where they're going in the future. For example, if somebody was trying to value their stock, you'd want to consider what are the threats to BlackBerry's company going forward on a going forward basis, and see, do you want to use, and hopefully you would be using those future revenue growth rates to value the stock going forward. Other things that you want to use in terms of figuring out how you want to, or how high of a growth rate you want to attach to that future revenue growth rate, is you want to look at the impact of acquisitions and divestitures. So if you just did a large acquisition, just like the Dollar General case that we talked about, if you have an impact of an acquisition, you really want to make sure that you get that correct revenue growth rate, because you will have a much higher revenue growth rate going forward, but you would expect that you would have some of your existing store sales, for example, to be cannibalized in that process. If you have a divestiture of a company, you need to really consider how this is going to impact your revenues and future expenses. It might not just, your expenses, for example, might not be impacted just by the same rate that your revenues are lowered as a result of having the divestiture. The final thing you want to look at, or a final large thing that you want to look at, is the impact of existing versus new store growth. So new store growth can be more costly than organic growth, and organic growth also might be, it will typically be at a lower growth rate than if you obviously just acquired another company and you get immediate revenue growth today. Other things that you want to consider are, in your revenues, it's not just by selling more. It could be by increasing your unit sale price. So that's another thing that you want to consider in terms of how much that's going to impact your revenue growth going forward. Next, when we're looking at forecasting expenses, these will typically just follow the example of, or the expectation that we have for our revenue growth going forward. So if you're a company that's just selling products, typically, if you're going to increase the number, or hopefully increase the number of products that you're selling, or increase the price of your products, usually your operating expenses will typically follow that if you're just increasing the number or the amount of sales that you had. If you're just trying to get revenue growth by increasing the price of your products, then typically your operating expenses may fall at a lower growth rate, because if you're increasing the price of your product, that's not going to impact how much it takes to produce that product. So it's another consideration that you want to have when you're forecasting your expenses, your operating expenses. Another thing to consider are your forecasted income tax rates. So usually your income taxes are going to stay at a pretty level rate year over year if your company does primarily the same type of business year over year. However, when you're looking at forecasting your income taxes, let's say you're just looking at your last few years, you really want to make sure that you didn't have the benefit of, for example, a one-time tax credit, or your income tax rate, your effective income tax rate could have been lower, for example, if you used certain credits from prior years. So companies get large credits if they have net operating losses that they can carry over year. So that's another thing that you want to consider, is that let's say you had a much lower effective tax rate last year. You want to make sure that you're forecasting your income tax rate for the next few years based on what your expected effective tax rate is over time, and that you're not just getting the benefit of having a really low one last year, for example. When we're looking at our non-operating expenses, these would be things like investment expense or interest expense. Typically for valuation practice, we just assume that our non-operating income or expense items are going to remain the same as they did in a prior period. So once we have our income and expense items or assumptions input into our forecasted income statement, then we need to see how these revenue and expense items impact our balance sheet. So when we're looking at our balance sheet, if we look at our revenue forecast items, typically we would expect our revenues to have a large impact. If we're expecting a lot of growth, we would expect that to have a large impact on our cash and accounts receivables, because that would impact then how much we're receiving in cash and accounts receivables. If we're looking at other items that we need to make sure that we have increased enough as a result of our revenue growth, that would be our inventories and our PP&E. So things like that we need to make sure that we have enough of those on our balance sheet, and that we invest in enough of those. It's just going to take cash, which we'll get to in a second. But we need to make sure that we have enough assets in our balance sheet to support our growth. So we need to make sure that these are being forecasted appropriately. Other things then, if we're looking at our expense side, if we have our operating expenses and our cost of goods sold expenses, those are going to be increasing typically in line with our revenue growth. So we need to make sure that our liabilities for accounts payable and accrued liabilities, so things like our any of our wages payable or income taxes payable and our short-term and long-term liabilities, we need to make sure that those are forecasted properly as well to support that growth going forward. So when we're looking at our cost of goods sold and our operating expenses, these I'll go through pretty quickly, but these we just want to make sure that we're taking in the considerations that we talked about before in terms of making sure that they are increasing in line with our expected revenue growth. Cost of goods sold, we would typically expect to maintain that same percentage as our revenue growth going forward, unless we have some major impact based on how we can price what the cost would take to develop our products going forward. So for example, if we are able to negotiate a large decrease in a component cost with the supplier, for example, for a good that we are trying to manufacture ourselves, if we have a large decrease in that cost, then yes, we can expect our cost of goods sold to decrease, but generally we expect the cost of goods sold to increase in the same percentage that we would expect our revenues to increase. Operating expenses, we usually typically expect to have the same increase as the percentage growth in our revenues. But like I mentioned, if there are certain, for example, if we are going to just increase the price of our product in order to increase our revenue growth, then we would expect that certain costs, like our operating costs for administrative expenses or SG&A, would not we would expect those not to change. We would expect those to stay in line if we are just increasing the price on our product. So again, just making sure we know what exactly is impacting our revenue growth going forward. Okay, so when we look at our balance sheet growth, when we look at this for the, we're going to look at this in depth with the residual income method. But when we're looking at our total assets, we need to make sure that those assets, and when we have revenue growth, we need to increase our assets on our balance sheet in order to support that growth going forward. We also need to make sure that we have enough for the capital to support those assets. So for example, if we look at our working capital on our balance sheet, working capital is our current assets less our current liabilities. Our buffer zone is usually going to be our working capital. And primarily, we're going to look at what we have for our margin of safety, so our working capital, which is our current assets, less our current liabilities. And specifically, we're going to look at our amount of short-term debt on our balance sheet to see what we have to finance that growth in the immediate future. If we don't have enough to finance our growth with our current working capital and short-term debt on our balance sheet or availability of short-term debt, then we need to look at taking on financing via long-term debt or consider issuing stock in the future in order to support that growth going forward. So something to keep in mind is how we're going to finance our growth and making sure that our current balance sheet will sustain that growth. And if not, we need to start considering how we're going to finance that growth going forward. So the first thing that we're going to do when we're looking at forecasting our balance sheet items is we're going to start with forecasting the amounts that we expect are not going to change. So these are typically going to be our non-operating assets. So investments in securities, things that we have for discontinued ops that we expect are going to start winding down, eventually we won't have on our balance sheet, and any other non-operating investments. Typically for the valuation process, we assume that those remain the same. Then the other thing we're going to do, second step, is look at forecasting amounts for contractual or specified amounts. So for example, this is going to be for if we're looking at our long-term debt, for example. So if we look at our long-term debt, and let's say we don't have current payments on that debt this year or next year. So let's say, for example, we're looking at a 20-year loan, but we know that we have very large principal payments coming up within the next 3 years or 5 years. Those are things that we want to make sure that we're projecting for example, our balance sheet and our future in our cash flow statement. So, for example, if we're looking at debt, we wouldn't always expect to have our interest expense on our income statements or the interest payments we show on our cash flow statement to be necessarily 100% indicative of what our current or our existing debt obligations are. So we really want to make sure that we understand what the amounts are for debt payments in the next 3 to 5 to 7 year forecast that we're doing for our valuation. So we can make sure that we're considering those in the valuation process. Then the third step is really just forecasting our amounts in relation to our revenues. So like I said, typically most of our balance sheet amounts are going to be moving in relation with our revenue percentage increases, for example, or expense percentage increases. But there are certain things that might just move or might just stay the same year over year. So for example, those could be things such as our wages payable or our income taxes payable. So we really want to see if those are going to stay the same as a result of our valuation. So typically when we're looking at forecasting revenues, they're just going to be a percentage of our revenues. So for example, if we're looking at how much do we expect our inventory to change? If we're expecting our revenue to increase 5%, then we would just forecast our inventory to change as an increase of 5% year over year. So that first forecast example says forecast using a percentage of revenues, and we would just forecast that onto our for example, our operating assets on our balance sheet. Other more complicated ways of forecasting our balance sheet, for example, could be focusing on turnover rates or days outstanding. So we'll see this in more detail when we go through the Ferrari case on Thursday, but forecasting a balance sheet using turnover rates would be looking at, for example, if we think of our example with the Costco case. Remember in the Costco case or Costco example, I said that the company had a very good inventory turnover rate compared to their accounts payable turnover rate, and we looked at their days outstanding, and we saw that their inventory turnover was it produced a value of 29 days outstanding. So we said their inventory was sold to their customers within 29 days, and their accounts payable was paid to their suppliers in 31 days. So for example, if you know a company like Costco very much relies on being able to receive cash from their customers on their inventory sold before they have to pay their suppliers for their inventory paid, so what they have to pay back their suppliers for getting that inventory on their shelves, we would need to make sure that we keep this days outstanding and turnover ratio the same for Costco on any forecasted balance sheets, because that's the main driver for them being able to keep low amounts of interest rate, and it's very important to their business strategy to keep up those small but somewhat major profit margins for Costco. So that would be something for a company that you would need to forecast using those turnover rates and days outstanding, then rather than just looking at a percentage of revenues. So for this, primarily for this class, for our example, and for the final case example, we'll just be looking at typically percentage forecasts. But for our example, for a few of their accounts, we do look at diving into the days outstanding. Okay, so when we are now looking at jumping into the valuation methods, now that we've talked a little bit about the intro to valuation, certain things that you need to consider when you're doing valuation, we can look at, first of all, the residual income method, which is a bit different than what you've seen in your other classes for the DCF method. But the residual income method is looking at your book income. So you're looking at your net income, and what you're doing is you're forecasting the company's growth or expected growth based on that book income. And you are putting a residual or an equity charge to that book income. That equity charge is known as the required return on equity. And the thought here is that you are trying to figure out a company's residual income and value them based on that. Because just because a company is making net income or book GAAP income on their income statement doesn't mean that they're actually providing value for their shareholders, because value for a company's shareholders is being derived from, are you able to pay them dividends, or are you able to derive income to invest back into the business, or are you able to do other measures that we talked about in this class that can give value back to your shareholders in terms of repurchasing shares. All those things are things that you want to make sure that you have up, or that you have the income available to do that in order to give additional income back to your shareholders, returns back to your shareholders. And that's why the residual income method is important to look at, because that looks at, do you have an actual amount of value to give back to your shareholders after you look at how much money or how much income you get based on your net income statement. So if we look at the residual income method in detail, we're looking at the firm value of a company, which is calculated based on looking at their net operating profits plus the present value of their respected residual operating profit. And that's based on calculating out their expected residual income over the next few years and discounting that back to the present value, or giving a present value on that residual income to see what the value is today. So it's similar to the DCF in the sense that we're forecasting out something and then we're discounting out that multi-year forecast to a value today. But for the residual income method, first of all, instead of forecasting out cash flows like we do under DCF, we're forecasting out book income or net income. And then what we're doing is we're establishing a charge on that net income. So we're going to reduce that net income or book income based on a charge for the cost of equity, which we'll calculate shortly. So we're subtracting out that equity cost or equity charge from their net income. And then that is going to be the amount that we discount back to a present value today. So with the residual income method, we are just focusing on operating profits, operating income, operating assets. So we're just trying to see what's the value of the company by doing what they do as far as selling their goods and services. And then there's a lot of similarities to the DCF method. So when we calculate out this method, we'll want to draw similarities to the DCF method to see what's really driving this method compared to the DCF, and when you want to use one over the other. So when we're looking at the residual operating profit method, this is going through the steps that I just discussed. We're looking, first of all, same as the DCF, we're forecasting our sales or revenues based on our sales growth assumptions. And what we want to do is figure out do we have the assets available to sustain that growth going forward? So we want to derive the net operating asset side of the balance sheet, and this is just making sure we have enough assets to grow our company. And then what we want to do is assign a value for our net assets to net capital. So this is just really looking at how much of our assets are financed by debt compared to equity, because when we assign the equity charge, which is a subtraction from net income under the residual income method, we want to get a charge only for the equity side of our balance sheet, because we are only getting the cost of equity and attaching that to our equity side. So we want to see if our value for our assets is going to be split between debt and equity going forward, just like it has historically. So for example, if a company has 30% of their assets financed by debt and 70% financed by equity, we'll want to see if we can still grow our company, and if those assets are going to be financed by 30% debt versus 70% equity going forward, just like it has historically. Then we're going to derive our forecasted net income, so take our forecasted revenues less our forecasted expenses. And then we're going to derive our residual income. The residual income is taking our net income in step D less our charge for our cost to equity. And then step F, we're going to discount that forecasted residual income back to the present time. So we're going to look at how many forecast years we're going to determine based on, is it going to be 3, 5, or 7, whatever we want to use in our valuation. And then we're going to discount those forecasted residual income years back to the present value. Then we're going to aggregate the forecast components, which is going to be our residual income for the forecasted period, our terminal value for future residual income, and then we're also going to assign a value for our net book value or our net assets on our balance sheet, and that's going to be the third component. So we're going to talk through the rest of this lecture conceptually about the residual income method, and then we're going to apply it in practice with the Coca-Cola case. So I'll walk through this, and it'll make more sense when we walk through it on the Excel in class on Thursday. So to look at this just with some very simple examples, we can look at the number of assets that a company has, consider their debt to equity ratio, the cost of their debt, the cost of their equity, and figure out what's their residual income to figure out what value are we going to use in our discount valuation. So in this example, the company has $5 million in total assets. Their total debt to total capital ratio is 0.6. So that means that 0.6 or 60% of the $5 million in assets are financed by debt, 40% by equity. The cost of debt before tax is 8%. The cost of equity is 12%, and their tax rate is 40%. So if we look at the next slide, if they have EBIT of $400,000, so operating income of $400,000, and if they have interest expense of $240,000, this means that the company's pre-tax income is $160,000. So the thing I'll point out here is that we're only taking a charge for the cost of equity. We're not taking a charge for the cost of debt under the residual income method, because you'll see that in this example, we are discounting a value based on an after debt or an after interest expense amount. So the amount that we use here to figure out what's their net income to figure out their residual income is going to be the amount that is after their interest expense, so after the $240,000. So if we finish this example, we have pre-tax income of $160,000, so this is after their interest expense. We have income tax of $64,000, so their net income now is $96,000. So their net income on their income statement, their GAAP income, is $96,000. So the next step that we want to do under the residual income method is establish how much of a charge do we want to have for the cost of equity, and that's going to be established against that $96,000 of net income. So flipping to the next slide, we know that they have equity capital of $2 million because 40% of those $5 million in assets are financed by equity, and they're going to have an equity charge of $240,000. So the equity charge is established based on their residual income. Their equity charge is established to get to the residual income based on their value of their equity assets on this side. So their equity capital, or their assets that are financed by equity, is $2 million. And their equity charge is 12% if I flip back to this slide. So $2 million of the $5 million of assets are financed by equity. So they must have capital of $2 million. And I want to take the charge for the cost of equity of 12% against that $2 million. 12% of $2 million is $240,000. So I want to subtract the equity charge of $240 million from their net income of $996,000. And this is telling me now that the firm has residual income of negative $144,000. So what the residual income method helps us see is that a company might have positive GAAP income, so positive income of $96,000, but you'll see that once we take into account the equity charge of 12%, that equity charge is really what we need to compensate our shareholders for taking on the risk of investing in our company. Once we apply that equity charge of $240,000 to the $2 million of equity capital, we are left with negative residual income. So this company is not providing value or enough value to their equity shareholders because they're not able to actually compensate for that equity cost of 12%. So the residual income really helps us see, is the company able to provide value to their shareholders? And really, are they able to account for that cost of equity, which is 12%? So if we look at how do we forecast the residual income over the next few years, let's say the book value of a share is $20 for this company. In this example, let's say the required equity return is 10% for this particular company. Let's say the company in years 1 and 2 has earnings per year of $2.50 per share and $3 per share in year 2. And we'll say the company is going to pay dividends of $1 per share in year 1 and $1.10 per share in year 2. So if we look at the charge for equity capital, in year 1, the required equity charge is going to be $2 because the required cost of equity is 10%. And if we apply that 10% to the beginning book value per share, which is $20, we get an equity charge of $2. So if we look at the residual income of year 1, remember the earnings per share for this company in year 1 were $2.50. And now we have a charge or a cost of capital for equity of $2 per share. So the residual income for this company in year 1 is 50 cents. So the company does have residual income. If we look at the ending book value now for the company in year 1, remember our beginning book value per share was $20. Our earnings per share, EPS calculated, was $2.50. And the company is also paying dividends of $1. So the beginning book value of 20 plus earnings of 250 minus dividends of 1 means that we have a end of the year book value of 2150. This is going to be the new book value then that we use to compute the charge of equity capital in year 2. So to compute the required equity charge in year 2, I'm going to take 10% of the beginning book value for year 2 of 2150. And that means that my required equity charge for year 2 is $2.15. So my residual income now for year 2 is the $3 EPS minus the $2.15 for the equity charge in year 2. And my residual income is now 85 cents in year 2. So if I look at the, continuing on with this example, I'm seeing that my value for my stock over the next 3 years is going to be a component of the 3 metrics that I just calculated. So we had a beginning book value of $20. We had residual income in year 1 of 50 cents and residual income in year 2 of 85 cents. And we have a required return of equity of 10 cents. So if I skip to the next slide, you'll see that in order to discount this back, let's say my residual income per share in year 3 was $1. I'm going to discount my flows of 50 cents per share residual income, 85% per share residual income, and dollar per share residual income at 10% over the next 3 years. If I discount that back to today's value, I get a value of $1.91 on the streams of 50 cents, 85 cents, and $1 residual income over the next 3 years. And under the residual income, we also want to add in the value of our beginning book value for our assets, or our net assets on our balance sheet. Net assets being our assets less our liabilities, and that just gets us down to what our equity value is on our balance sheet. So you'll see under the residual income method, my components also includes the $20 for the beginning book value of our equity. If I sum up the beginning value for our equity of $20 and the residual income calculated of $1.91 discounted back to a present value today, under the residual income method, the value of my stock per share is $21.91. So if we look at the strengths of the residual income method, you'll see that the residual income method uses available accounting data. So we're able to see what a company is going to project out for earnings and expense estimates over the next few years. But this can also be a weakness to the method because, as we know, GAAP accounting doesn't always reflect the economics of a firm. So for example, if you look at a company like Amazon, Amazon has low earnings or low book earnings because they're investing heavily in different infrastructure for the company today. So they're investing heavily in warehouses and servers in order to grow their Amazon Prime and their Amazon Web Services. So they have very little GAAP income, but they have a lot of cash inflows and outflows going out. They have a lot of cash that they receive from their customers and their profits. And their cash from their operating activities is perhaps a better indicator of the company's future health going forward. Another strength of the residual income method is it's very useful to use when cash flows are unpredictable. So cash flows can be unpredictable based on a company's investments. So if they buy a lot of PP&E, they could have low cash flow today. Accounting would allow us, our book accounting would allow us to lower the amount of expense that we're taking on that PP&E by allocating out depreciation over the next few years. So we're going to get a more fluid and a more normalized approach to our net income over the next few years compared to what our actual cash flows are. And another strength of the residual income method is it really allows us to follow economic value being what we're providing, the value we're providing to our shareholders. And it does account for a charge for equity. So just because, like I said, a company can have net income, but if they aren't recuperating or reciprocating to their shareholders the cost of equity that is due to them for taking on the risk for investing in our companies, then the company is not able to see what is the true value that we're providing to our shareholders, and they could have positive net income but negative residual income once they take into account, for example, that 10 or